As of Saturday, December 20th, 2025 at 7:43 p.m. IST, the market is currently closed. Amicus Therapeutics, trading under the ticker FOLD on the Nasdaq, finished the last active trading session on Friday, December 19th, 2025 at a price of 14.18 USD. This represents a massive intraday surge of 30.21%, with the stock climbing 3.29 USD over the course of the session. While the headline figures tell a story of a sudden and violent upward re-rating, the real insight here isn't just that the stock moved, it is why the market stopped where it did. On Friday morning, BioMarin Pharmaceutical announced a definitive agreement to acquire Amicus in an all-cash deal valued at 14.50 USD per share. If you look at that 14.18 USD closing price, you see a small but deliberate gap of about 32 cents between where the stock sits and the actual buyout price. This tiny margin is effectively the market's way of pricing in the time it will take for the deal to cross the finish line, and the microscopic risk that a regulatory hurdle could slow it down. It's a classic arbitrage scenario, and for long-term holders, it feels like the ultimate validation of a narrative that has been building for years. The general expectation for Amicus Therapeutics over the last year was that it would eventually become a steady, profitable, mid-cap biotech player on its own merits. Most investors were focused on the commercial ramp-up of Galafold and the rollout of Pombiliti and Opfolda. The belief was that by mid-2026, the company would be throwing off enough cash to fund its own pipeline without needing to return to the capital markets. However, the reality we're seeing today is that the independent growth narrative was just a setup for a much larger strategic exit. BioMarin didn't just want the revenue, they wanted the market dominance Amicus has carved out in the rare disease space, particularly in Fabry and Pompe diseases. By offering 14.50 USD in cash, they've essentially put a hard ceiling on the stock, while providing a safety net that few expected to materialize this abruptly. It's a total shift from speculative growth to a merger and acquisition play, and it changes how every single investor needs to look at their position in the coming months. If you're looking at your screen today, the volume on FOLD was absolutely staggering. We saw over 100 million shares change hands in a single day, compared to an average daily volume that usually hovers around 5 million. This kind of institutional activity suggests that the smart money is moving in to lock in the arbitrage spread. When a stock gaps up 30% on a buyout, you often see retail investors rushing to the exit to take their profits, while institutional arbitrage desks at firms like Fidelity or those using the Interactive Brokers platform step in to buy up those shares, happy to clip a 2 or 3% return over the next few months as the deal closes. This creates a very stable yet very boring trading range. If you're used to the volatility of biotech, the next 2 quarters for Amicus will feel like watching paint dry, as the stock will likely hug that 14.18 to 14.40 USD range until the second quarter of 2026, when the transaction is expected to finalize. This movement is a huge contrast to what we've seen in the broader biotech sector recently. While names like Nvidia stock or Apple stock often dictate the sentiment of the general market, the biotech niche operates on its own set of rules, usually governed by clinical data or M&A activity. For many who use Schwab Intelligent Portfolios or other forms of online investing, seeing a 30% jump in a single day is the dream scenario. But the reality is that once a buyout is announced, the alpha, or the chance to outperform the market significantly, is mostly gone. You're now essentially holding a high-yield cash equivalent. If you're managing an individual brokerage account or using a platform like Robinhood, you have to ask yourself if sitting on a 2% spread for 6 months is the best use of your capital, or if those funds could be better deployed into other high-growth opportunities. I want to hear from you on this. Comment below how many shares of Amicus Therapeutics you currently hold, and if you plan on selling now or waiting for the full 14.50 USD payout. To understand why BioMarin is willing to pay $4.8 billion for this company, we have to look at what Amicus actually does. They're a global biotech firm that has successfully transitioned from an R&D-heavy shop into a commercial powerhouse. Their lead product, Galafold, is the first and only oral medicine for people living with Fabry disease who have specific genetic variants. It's a chaperone therapy, meaning it helps the body's own enzymes work better rather than just replacing them. This has given them a massive competitive moat. Then you have Pombiliti and Opfolda, their two-component treatment for late-onset Pompe disease. In their most recent third-quarter report, Amicus finally hit GAAP profitability, which is the holy grail for biotech companies. They reported revenue of $169 million for the quarter, up 17% year over year. They weren't just a company with a good idea, they were a company with a proven, profitable business model that was already serving thousands of patients globally. The irony here is that the very success that made Amicus a great self-investing pick for long-term bulls is exactly what made it an irresistible target for a larger predator. BioMarin is a giant in the rare disease world, and by absorbing Amicus, they eliminate a competitor and gain immediate access to a massive stream of recurring revenue. For investors using Fidelity Investments or SoFi Invest, this acquisition is a reminder that in the current market environment, biotech companies that reach profitability don't stay independent for long. The larger players have too much cash on their balance sheets and too much pressure to grow their pipelines to let a profitable mid-cap like Amicus stay on the shelf. When we look at the future outlook for FOLD, the path is largely dictated by the merger agreement. The reality of the stock price will be tethered to 14.50 USD. However, there are still a few catalysts to watch. Regulatory approvals in various global jurisdictions are the main hurdle. If there are any whispers of antitrust concerns, though unlikely in such a specialized niche, the stock could see some temporary dips. Conversely, there's always the slim possibility of a topping bid from another pharmaceutical giant. While the board has already given the green light to BioMarin, if another company decides that 14.50 USD is too cheap for such a high-quality asset, we could see a bidding war. This is the only scenario where the stock breaks above the 14.50 USD ceiling. It's a low-probability event, but in the world of online trading and biotech, you can never say never. For those using the Robinhood app or SoFi trading platform, the strategy now shifts to risk management. The expectation was that Amicus would grow into a $20 or $25 stock over the next 3 years. The reality is that you're getting 14.50 USD today. For many who bought in during the lows of 2024 when the stock was under $6, this is a home run. But for those who joined the party recently, the upside is capped. This is where professional-grade tools like the Interactive Brokers platform or specialized Fidelity mutual funds come into play, as they allow you to see where the institutional flow is moving. If you see massive block trades at the current 14.18 USD level, it means the big players are happy with the deal. Looking at the macroeconomic picture, the Fed's recent moves on interest rates have made cash-heavy deals like this more attractive. When borrowing costs are predictable, larger companies are more willing to pull the trigger on multi-billion-dollar acquisitions. This trend is likely to continue across the biotech sector into 2026. If you're looking for investment help or exploring different investing sites, keep an eye on other profitable mid-cap biotechs. The Amicus deal has set a new benchmark for valuations in the rare disease space. It shows that the market is willing to pay a premium for companies that have moved past the clinical trial phase into the commercial success phase. To wrap this up, the story of Amicus Therapeutics is a textbook example of the gap between market narrative and corporate reality. The market expected a long, slow climb to independence. The reality was a swift, decisive buyout. We began the day with a stock that was fighting for attention and ended it with a company that is essentially a proxy for cash. The 30% jump to 14.18 USD is a testament to the value of the orphan drug business model. While the excitement of the daily price swings is mostly over for FOLD, the lesson for investors remains clear. Focus on companies with high gross margins and a lock on their specific patient populations. In summary, the BioMarin acquisition of Amicus for 14.50 USD per share has fundamentally changed the nature of this investment. We saw a massive surge in volume and a definitive repricing that has effectively stabilized the stock near the buyout price. The